Good afternoon, traders. It's Bill Baruch with Blue Line Futures, and it's your daily midday market minute. CPI is on deck, but before I get to it, if you're watching this on YouTube, please click the link below and subscribe. Like and subscribe. If you're watching from our website, there's also a link below to direct you to YouTube. You can subscribe that way. We'd love you to follow us. We'd love you to help us build our following. All right, let's get to it here. CPI is on deck, and it's going to be a big number. It's going to be a big number for a couple of reasons. Obviously, the equity markets have sold off a bit here in recent days. The S&P is about 3% from its recent high. The NASDAQ, about 5% from its recent high. But it's also crucial because if you go back to last year, inflation heated up into June. And the month-over-month increase in June was 1.2%. But the month-over-month increase in July, and tomorrow's number is for July. It's out at 7:30 a.m. Central Time. It was flat in July. So that's going to have an impact on the potential, how the base comparisons show in this number. So if we see a month-over-month increase hotter than expected, it's really going to have an impact, again, on the year-over-year number. It's going to have an impact on the fact that inflation is starting to heat up again. But really, just from a headline look at things, the base comparisons being flat on a month-over-month basis, and they sort of snagged a little bit in the July coming out of the summer for the last 2 years, it's going to really have an impact on the way the market digests this, especially early on. So what we're looking at is the Cleveland Fed has a hotter than expected expectation on their models than analysts. So analysts, they're looking at 3.3% year over year on the core and a 2/10 increase month over month on the core. However, the Cleveland Fed is looking at 3.4% and a 4/10 increase month over month. If you look at the headline number, the analysts look at 4.7% year over year and a 2/10 increase month over month. However, the Cleveland Fed has 4.9 and 4/10. So we're looking at those two. And here's something to kind of digest. If the market, if the number comes out in line with expectations tomorrow, in line, maybe even just the slightest bit hot, but it's still below the Cleveland expectations numbers, we'll probably see sort of a risk-off event. Equities sell off, some of the commodities sell off. You'll see treasuries sell off as well. But once the dust settles, we could see a rally out of that because those expectations are within the Federal Reserve's model. That's the important thing to know going into tomorrow. The other part of it is, as I mentioned, the S&P is 3% from its recent cycle high, the NASDAQ 5%. The selling is already, a lot of it has already come in. People have sold, people have taken positions off, lighten the load a little bit here. And that's important because earlier in the year, it is a bull market, and bull markets fuel speculation. When the market is rallying ahead of these CPI numbers and the CPI number comes in a little bit light, well, guess what? It's already discounted that, and we didn't see the market really extend in the days surrounding that CPI number. So that's important. Since the market is sold off, I'm going to look at, if we do trade lower, where are the next support levels. Now, we do have a big one here in the S&P, 4470 to 4473. We didn't quite get there today, 4478. Still kind of traded around yesterday's low that we came out pretty good. Came out again today of that low, pretty good, but we sold off late in the session. That late session selling, I think, is important. It's going to have an impact on how that number is digested tomorrow. Same thing with the NASDAQ. A lot of support around 15,260. But again, there's a lot of levels around there, even down to 15,000. A lot of this I will be re-highlighting and updating on the Morning Express going into tomorrow. But below there in the S&P, I'm looking at this closing levels in the middle of June, 4440 area. And I would think if we do go lower, I would expect the market to respond. And why? Because inflation ultimately is trending lower. Expectations for inflation are trending lower. Expectations for the Fed to start cooling its tightening are in place. And what we need to see here, the fact that the market is sold off, I think, again, it's discounted a lot of that. So it's how the market is skewing those expectations. It is a bull market. We maybe have been selling off a little bit here in the last couple of weeks, but it's a bull market amid slowing inflation. And that's how the market will digest it, unless we get a really hot number and unless those base comparisons have a really wonky effect. That is my fear, is where we have a very wonky effect on the base because of those base comparisons, and you get a number that's 5% or above 5%. If we see a 5 handle, we're going to see the treasuries continue to sell off, and probably equities could probably break that 4440 support in the S&P. So keep that in mind. We do not want to see a 5 handle, even if that would be just a little hotter than Cleveland. But I don't think the market is really prepared for that, at least in the very near term. So remember that as we go into tomorrow. And then 4/10, though, that does give a little wiggle room. What if we do see a 5 handle on the headline inflation? What does that mean? And how did we get there? What's the month over month increase? Are we hotter than 4/10? That's how we have to look at it. You have to look at those expectations. I think it's going to be a big number. Now, the treasury market is really going to dictate that reaction. What do we see from the treasuries? The 30-year bond, we've been talking about this a bit. Ackman went short in size last week. And we've basically rallied since then. A lot of resistance at 122.30 in the 30-year bond. That was the previous low. We need to start getting above 123, which we traded today. Really start getting out above there and holding out above there to create a short cover, because leverage shorts, according to the CFTC, these are the hedge funds, the CTAs, there is a 10-to-1 short position, nearly a record short position in bonds right now. So keep that in mind. The bond starts to boogie, then there's going to be some short covering. Every rally starts to short cover. For the 10-year, there's some solid resistance up near 112. We finished here today about 111.11, 111.12 area. 112 is where that resistance is. We need to get above there. The 21-day moving average is there. We also have a trend line from the May highs that if we get above there, it can start creating some additional tailwinds. Again, short positions would have to start to cover. So I'm watching that. I'm watching the belly of the curve most closely. But what I would be most concerned too, if the bond starts selling off, is that 2-year yield back above 5% decisively, and is the 10-year yield getting out above 4.2%, that previous high. So keep an eye on all of that. It really all matters as we digest things. We see how the currency markets react. The yen finished down near 70. See how that trades overnight. If that continues to sell, that could hurt the risk environment a little bit. It's likely would be happening because of higher yields and lower treasuries. The Chinese yuan has been weakening, which be seen as a rally from the CME's C&H contract. So keep an eye on that. That's been hurting commodities. So we watch the currencies, we watch the rates, we see how they all react to tomorrow's number, because that's going to really tell the tale here of how the risk environment is going to treat all that. If you're trading stocks, if you're trading crude oil, you're trading copper or gold, all of this is going to factor into that. And our team is here to help. So give us a call, 312-278-0500. That's right to our trade desk. We're here to help, 312-278-0500. Remember, futures trading involves substantial risk of loss and is not suitable for all investors.